Why does a bank's LCR matter for retail depositors? The Reserve Bank of India, that's the RBI, recently conducted special audits with banks to verify their holdings of eligible securities for maintaining the liquidity coverage ratio, that's the LCR. This is a special audit meant to prevent the sudden collapse of banks, like what happened in the US with Silicon Valley Bank and Signature Bank. These audits verify whether securities classified as LCR by banks are truly liquid. What is LCR and why does it matter for retail depositors? ET explains. What is LCR? A liquidity coverage ratio requires banks to maintain high quality liquid assets, that's HQLA, or assets that can be quickly converted into cash to fund sudden cash outflows in stressed conditions for 30 days. These HQLAs are typically in the form of treasury bills. This protects the bank's ability to give depositors their money back when they are in a liquidity deficit. Why is LCR needed? The financial crisis of 2008 created a major liquidity shock to financial institutions worldwide, causing banks to default as many of them suffered an asset liability mismatch. If a bank has loans maturing in 10 years but deposits that are due to be paid in 3 years, it will struggle with repaying depositors. Subsequently, the Basel Committee for Banking Reforms implemented measures like the LCR requirement to boost the resilience of the global banking sector. Here's an episode showing the importance of LCR. US based Silicon Valley Bank was holding long term securities as they gave high returns. When the US raised rates, depositors wanted to repay debt and thus approached SVB to withdraw money. SVB did not have adequate liquid securities to pay them and had to sell long securities and raise debt to repay depositors. This news led to panic and subsequently a run on the bank. Why is RBI conducting a special report or an audit? RBI has started conducting special audits as concerns arise about banks with a high credit deposit, that's the CD, ratio, and whether these banks would be able to show their LCR requirements. The central bank highlighted that as digital payments become mainstream, depositors can quickly withdraw or transfer their funds during times of stress. This emerging risk may have prompted RBI to conduct special audits. What are LCR requirements? The current LCR requirement is 100%, but RBI reduced its requirements to 80% in September 2020 to accommodate banks' cash flow during COVID-19. In April this year, the central bank said it would review its LCR framework after a few overseas institutions had customers withdrawing their deposits on a short notice due to the ability of instant digital payment modes. What is the difference between the statutory liquid ratio, that's the LCR, that's the SLR, and the LCR? Statutory liquid ratio or the SLR is the percentage of deposits that a bank must maintain with government securities as a reserve requirement. The current SLR in India is 18%. All SLR eligible assets banks hold can be recognized as HQLAs to meet LCR requirements. SLR was always a requirement, and LCR brought a second parallel liquidity requirement. What is the facility to avail liquidity for liquidity coverage ratio or fall CR? The two parallel liquidity regulations cited above use very similar assets and, if combined, will substantially reduce banks' lending capacity. To prevent this overlap of assets, RBI has permitted a limited amount of government securities used to meet SLR requirements to be approved as HQLA for calculating LCR. Also, so when banks invest in sectors to meet their SLR requirements, they can also pledge the same meet their LCR requirements as well. Currently, the total HQLA carve out from the mandatory SLR, which can be used for meeting LCR requirement, is 17% of net demand and time liabilities.